The 1920s in the United States were a decade of dazzling lights, jazz rhythms, and a new spirit of endless possibility, known as the Roaring Twenties. It was a time when cities boomed, industries expanded, and Americans believed they were on the edge of a golden future. Skyscrapers rose like monuments to ambition, automobiles rolled off assembly lines in the millions, and radios carried music, news, and dreams to every living room. Wall Street, the heart of American finance, pulsed with energy and optimism. The stock market was not just growing, it was roaring. Investing became more than a pursuit for the wealthy elite. It became a national sport. Teachers, factory workers, farmers, and housewives poured their savings into stocks. Why not? Prices seemed to rise endlessly, and everyone wanted a piece of the American dream. Brokers offered an irresistible temptation called buying on margin, allowing people to borrow most of the money they needed to buy shares, sometimes as much as 90% of the price. For a few dollars down, you could control a fortune. As more and more people joined in, the market climbed higher, feeding a cycle of greed and hope. The culture of the time reinforced this illusion of permanent prosperity. Newspapers printed daily success stories of overnight millionaires. Radio broadcasts spoke of modernity and progress. Even President Herbert Hoover famously predicted that poverty in America would soon be a thing of the past. But beneath this glittering surface, cracks were forming. Factories were producing goods faster than people could buy them. Farmers faced low crop prices and mounting debts. Wages for ordinary workers stagnated while corporate profits soared, widening the gap between the rich and the rest. By the summer of 1929, the warning signs were there, but few paid attention. Stock prices were far above their real value, inflated by speculation rather than true business performance. Banks were heavily invested in the market, meaning if the bubble burst, the entire financial system would feel the shock. Yet the party continued, louder and brighter, as if nothing could go wrong. This prosperity was a castle built on sand, a fragile balance of easy credit, walled speculation, and blind faith in a market that everyone believed could only go up. But in October 1929, reality would come crashing in, shattering that illusion and plunging the United States into the darkest economic chapter in its history. As summer turned to autumn in 1929, the stock market had reached breathtaking heights, but those heights were built on air. By September, whispers of overvaluation began to circulate. Yet most investors ignored them, convinced the boom would continue. Then, in October, the unthinkable happened. On Thursday, October 24, 1929, known forever as Black Thursday, panic struck Wall Street. Prices began to fall sharply, and the frenzy of selling began. Crowds gathered outside the New York Stock Exchange. Their faces pale as ticker tape spewed bad news faster than anyone could comprehend. Banks and major investors rushed in to buy large amounts of stocks in an attempt to calm the market, and for a brief moment, it seemed to work. The market steadied, and some hoped the worst was over. But the reprieve was short-lived. Over the weekend, fear festered. On Monday, October 28th, selling resumed with greater force. By Tuesday, October 29th, Black Tuesday, the dam finally broke. A record 16 million shares were traded in a single day, and the market lost billions in value. Fortunes were erased in hours. Brokers couldn't keep up with the flood of orders. Prices plummeted before sales could even be executed. People who had borrowed money to invest, the margin buyers, were wiped out almost instantly. They owed more than they owned, and banks that had lent recklessly to fuel this speculation suddenly faced massive losses. Outside brokerage houses, stunned investors watched their life savings vanish. Some reportedly fainted, others contemplated the unthinkable. The crash did not destroy the U.S. economy overnight, but it marked the moment when confidence collapsed. Businesses grew fearful, banks tightened credit, and ordinary Americans, once eager consumers, now clutched their wallets. Newspapers chronicled the fall with grim headlines, while politicians scrambled to reassure the public that recovery was near. The panic of those days was more than a market correction. It was a psychological shockwave. It revealed how fragile the prosperity of the Roaring Twenties really was, and it exposed the dangerous web of speculation, leverage, and blind optimism that had fueled the bubble. The crash was not just about numbers, it was about trust. And in October 1929, the trust evaporated almost overnight, setting the stage for a decade of hardship that would follow. The stock market crash of October 1929 was merely the initial tremor in a much larger seismic event that would reshape the landscape of American finance and society. What followed was an economic catastrophe that undermined the very bedrock of American life. In the wake of Black Tuesday, the fallout spread far beyond the confines of Wall Street. Banks began to fail at an alarming rate. Not just a handful, but hundreds, eventually thousands. At that time, the lack of federal insurance meant that when a bank collapsed, ordinary savers lost their hard-earned deposits in the blink of an eye. Panic spread like wildfire. As whispers of failing banks circulated, anxious customers rushed to withdraw their savings, igniting a series of bank runs across the nation. This frenzy drained the financial system of liquidity, leading to even more bank closures and amplifying the economic downturn. With credit evaporating, businesses that relied on loans for survival found themselves unable to borrow, and factories that once hummed with productivity were forced to shut down. By 1930, the repercussions of this crisis reverberated through the core of the economy. The job market, unemployment, which had been a manageable 3%, skyrocketed to over 15% within a single year, and by 1933, it surpassed 25%. 1 in 4 American workers found themselves without a job. Those fortunate enough to remain employed often faced drastic wage cuts and reduced hours. The exuberant dreams of the Roaring Twenties morphed into a grim reality filled with uncertainty. Urban centers became dotted with soup kitchens and bread lines, where once proud men and women stood in line for a single meal. Meanwhile, rural America faced its own crisis as plummeting crop prices devastated farmers already weighed down by debt. Foreclosures forced many to abandon their land, creating a tide of poverty that washed over both countryside and city. Children went to bed hungry, families crowded into shared homes. Some took to the roads, journeying state to state in search of jobs that had all but vanished. The intertwining crises of banking failures and soaring unemployment were not isolated phenomena. They exacerbated one another. Fewer jobs led to diminished deposits, while failing banks meant a scarcity of loans for businesses. This vicious cycle appeared relentless, trapping countless Americans in a downward spiral. Initially, the government, still clinging to the notion that the economy would self-correct, refrained from substantial intervention. President Herbert Hoover advocated for patience and voluntary cooperation among businesses, but this cautious stance only fueled growing frustration among the populace. As the crisis deepened, Americans began to lose faith not only in banks and markets but also in the very system that had once promised them prosperity and security. The Great Depression stands as a pivotal moment in financial history, marking a profound transformation in both the economy, the societal fabric of America. The exuberance of the 1920s, characterized by booming markets and a culture of consumerism, gave way to a stark reality where survival overshadowed prosperity. Families who once enjoyed financial stability faced dire circumstances, with eviction notices and empty pantries becoming common sights. Urban centers bore the brunt of this economic collapse, with breadlines and soup kitchens emerging as grim reminders of the period. Men, previously employed in respectable jobs, found themselves queuing for basic sustenance provided by charitable organizations. The irony was palpable as skilled laborers and veterans, once pillars of the community, were reduced to begging for food, a testament to the indiscriminate nature of the crisis. Hoovervilles, makeshift settlements named in derision after President Hoover, dotted the landscape, constructed from scavenged materials and housing those who had lost everything. In the agricultural heartland, the situation was equally bleak. Farmers faced plummeting prices and insurmountable debts, with many forced to abandon their land. The Midwest, plagued by drought and overfarming, witnessed the emergence of the Dust Bowl, a catastrophic environmental disaster that propelled thousands westward in search of new opportunities. The emotional ramifications of the Great Depression were staggering. Marriage and birth rates plummeted as families struggled to navigate the uncertainties of the era. Young adults postponed aspiration, while children left school to contribute to household income. Traditional roles shifted as women entered the workforce in greater numbers, seeking any available means to support their families. The entertainment industry adapted as well. Hollywood films and radio shows provided temporary escapes from the harsh realities of life, offering fleeting moments of joy amidst widespread despair. Perhaps the most profound impact of the Great Depression was the erosion of faith in the American dream. The belief that diligence and perseverance would lead to success seemed irrevocably shattered. For many, this period transcended mere economic hardship. It became a moral and psychological crisis that compelled a generation to reevaluate the very foundations of the society they once trusted.
Result: during the tumultuous years of the Great Depression, the United States found itself at a crossroads, desperately seeking effective leadership amidst economic turmoil. Initially, President Herbert Hoover, who took office with grand promises of unending prosperity, adopted a laissez-aller approach, believing that the economy would self-correct if left largely untouched. He championed minimal government intervention, advocating for businesses to maintain wages while urging local charities to assist the needy. However, as unemployment skyrocketed and banks collapsed, Hoover's reluctance to take decisive action faced mounting criticism. Many Americans perceived him as disconnected from their plight, coining the term Hooverville to symbolize his inaction and the dire living conditions of the time. By 1932, the clamor for change reached a fever pitch, paving the way for Franklin Delano Roosevelt FDR and his promise of a transformative New Deal for the American populace. This marked a pivotal shift in governance. The federal government would now take an active role in stabilizing the economy, reforming financial systems, and providing essential relief to struggling families. Between 1933 and 1939, the New Deal materialized through a series of innovative programs and reforms. Emergency support was allocated to banks, and the Federal Deposit Insurance Corporation (FDIC) was established to safeguard deposits and restore public confidence in the banking system. The creation of the Securities and Exchange Commission (SEC) aimed to regulate Wall Street, addressing the reckless speculation that had contributed to the financial crash. Public works initiatives, such as the Civilian Conservation Corps (CCC) and the Works Progress Administration (WPA), employed millions, constructing infrastructure that continues to benefit society today. For the agricultural sector, the Agricultural Adjustment Act (AAA) implemented measures to stabilize prices, while the Social Security Act of 1935 laid the groundwork for modern welfare programs, providing crucial support to the elderly and unemployed. These initiatives, though contentious at the time, fundamentally altered the relationship between the American people and their government, establishing a new expectation that in times of severe crisis, federal intervention was not only necessary but expected. However, the New Deal was not without its challenges. The Great Depression persisted for several years, and critics contended that Roosevelt's policies expanded federal authority excessively. Yet, for millions of Americans, these programs served as vital lifelines, not only restoring a semblance of economic stability, but also rekindling a collective hope that recovery was possible. The Great Depression finally began to ease in the late 1930s and effectively ended with the massive mobilization for World War II, which created jobs and revitalized industries. But its scars, both financial and psychological, never fully disappeared. For millions who lived through it, the memory of lost homes, empty banks, and endless breadlines shaped their view of money, risk, and government for a lifetime. One of the greatest legacies of the Depression was the birth of a new financial architecture in America. Institutions like the FDIC and SEC became permanent fixtures, ensuring that deposits were protected and markets were monitored. Banking reforms separated commercial banks from risky investment activities through laws like the Glass-Steagall Act, creating a firewall against future collapses. These measures built the foundation for a more stable system, one that aimed to prevent the wild speculation of the 1920s from ever repeating unchecked. Socially, the Depression reshaped the American dream. It fostered a culture of caution in the generation that endured it, saving more, spending less recklessly, and questioning the promises of easy wealth. It also strengthened the expectation that the federal government should play a central role in protecting citizens during crises, a concept that continues to shape debates over stimulus programs, unemployment benefits, and market regulation even today. Globally, the lessons of the 1930s influenced economic policies for decades. The crisis showed how interconnected markets could amplify risks and how panic could spread like wildfire without safeguards. It also reminded the world that unregulated speculation and unchecked greed can lead not just to financial ruin, but to political upheaval, as desperation often fuels extremism. Even in the 21st century, echoes of the Great Depression resonate. During the 2008 financial crisis, for instance, policymakers looked back to the 1930s for guidance on how to stabilize collapsing banks and restore confidence. The phrase "too big to fail" might not have existed in Hoover's time, but the underlying problem, the fragility of financial systems built on speculation, was strikingly familiar. Ultimately, the Great Depression stands as a stark reminder. Prosperity built on unchecked speculation is fragile, and trust is the cornerstone of every financial system. When that trust breaks, the fallout can reshape nations. And perhaps its most enduring lesson is this: recovery is possible, but only when nations learn from their past, act boldly in the face of crisis, and rebuild not just their economies, but the confidence of their people.